Welcome back to the deep dive. You know we love uncovering those high-stakes strategic moves in the markets, and today we are diving deep into a major one. We're looking at Altius Minerals, a staple in the royalty space, making this enormous, almost counterintuitive bet right in the middle of a battery metal slump.
It really is the definition of buying low, but with a massive ticket price. Altius is acquiring Lithium Royalty Corp, or LRC, for approximately $520 million.
$520 million, that's a huge number.
It is, and it immediately transforms Altius's profile and, its entire exposure to the lithium supply chain.
Okay, so let's unpack this a bit. Altius valued LRC shareholders at $9.50 per share.
Right.
And here's the tension rate. That $9.50 represented a whopping 29.6% premium to where LRC shares closed the day before.
A nearly 30% premium. I mean, that's the flashing light on the dashboard.
Exactly.
The central question for anyone following this is, are they crazy? I mean, lithium prices have just completely plummeted.
From what historical highs of?
Oh, we're talking about lithium carbonate equivalent, or LCE.
Yeah.
We've seen it swing from over $80,000 a ton.
Yeah.
Down to current lows near $9,000.
Wow.
So to commit $500 million now and pay a 30% premium, it just signals absolute conviction that the bottom is in.
So let's look at how they structured this bold bet. It's a plan of arrangement, right?
Yeah, a court-approved plan of arrangement. It's a common Canadian legal tool just to make sure all shareholder interests are properly addressed.
And what about the payment? Cash, stock?
It's a mix, and that's where it gets clever. LRC shareholders had flexibility. They could choose $9.50 in cash or 0.24 Helios common shares.
But there's a catch, I assume?
There's always a catch. This flexibility was very tightly controlled through proration.
Tell us about those limits, because that feels like the strategic move buried in the fine print.
It is. The cash part was capped at $173 million. So only about a third of the deal could be paid in cash.
And the rest had to be shares.
The rest, up to $347 million, is stock. By structuring it that way, Altius essentially forces most LRC shareholders to become long-term partners. They can't just cash out.
They're tied to the success of the new, bigger company?
Exactly. It's much more of a strategic merger for the long haul.
And they got a ton of support for this right out of the gate.
Oh, massive support. They had voting agreements locked in that represented almost 85% of LRC's shares before this was even really public.
So the vote is basically a foregone conclusion.
It dramatically de-risks the approval process, yeah. The whole thing's expected to close in Q1 2026.
And there was a bridge loan, too.
A subtle but really strong signal. Altius immediately provided LRC with a $20 million U.S. secured bridge loan.
So they're funding them even before the deal is officially done.
They're funding LRC's ability to potentially make more royalty acquisitions right now. They're putting capital to work instantly.
That's a fascinating show of confidence. Now let's talk strategy. This is the heart of it, right?
Right.
Why this countercyclical move when the lithium market feels so, toxic?
Well, this deal is like buying a prime piece of real estate when the housing market is terrified.
A bold analogy.
Altius believes the extreme volatility we've seen, the boom and the bust, is actually a sign that lithium is graduating. It's maturing into a mainstream essential commodity.
And that thesis is backed by some pretty serious demand projections.
Absolutely. Demand for LCE is expected to top 1.5 million tons globally this year, 2025. For a young commodity market, that's huge.
And the growth rates have been insane.
Phenomenal. We're tracking over a 30% compound annual growth rate for the last 5 years. And what's interesting is where the demand is coming from.
Everyone thinks EVs, but it's broader than that.
Well, much broader. The higher than expected surge is actually from grid-based energy storage. Utility-scale batteries, stabilizing power grids. They need massive amounts of lithium.
So that creates a kind of resilient floor under demand.
It does, regardless of what happens with monthly EV sales.
Okay, here's where it gets really interesting for me. The looming supply deficit.
This is the whole point of the bet. Despite the current low prices, analysts are projecting a market deficit is going to reemerge as early as 2026.
As in next year?
As in next year.
Okay.
And the current price, call it around $14,000 a ton. That is simply not high enough to incentivize building the massive new projects we need.
So we need higher prices to get more supply online.
Way higher. If you look ahead to 2030, global demand could hit 3.3 million tons. We are nowhere near the supply chain required to deliver that.
So Altius is basically using this price depression to stack up assets on the cheap.
Exactly. Knowing the long-term supply-demand imbalance is firmly in their favor. Their CEO, Brian Dalton, was very clear. They want long resource lives, strong cost curve position, and low jurisdictional risk. Quality assets.
Let's talk about that portfolio then. What are they actually getting?
They get 37 new lithium royalties overnight. And it's important to note, these are all traditional royalties, not streams.
That distinction matters.
It does. And they're focused on long to ultra-long implied resource lives. That's the optionality royalty companies are built on.
What's the quality of the pipeline like?
It's exceptional. 4 royalties are already on producing assets, and 3 of those are ramping up right now. So that gives Altius immediate cash flow.
Not just speculation then.
Not at all. And then the development pipeline is deep. We're talking 12 royalties on advanced stage projects that have already completed economic studies.
So these are projects that are very real.
Very real. 7 have full feasibility studies, and you can expect another 3 to 5 projects to start operations between 2026 and 2030.
And where are these assets located? That risk profile you mentioned.
Mostly in safe jurisdictions. Canada, Australia, and parts of South America. And they're diversified across production methods, too, both brine and hard rock. It mitigates technological risk.
Okay, let's talk numbers again. The payoff. What kind of revenue are we talking about?
Based on modeling, the new assets are expected to contribute annual revenue ramping up steadily to between $40 and $60 million by the end of the decade.
40 to 60 million.
And crucially, you have to remember that projection is calculated at current depressed spot prices.
So if prices recover,
that revenue figure just explodes.
Give us a couple of examples. What are some of these cornerstone assets?
Okay, so on the hard rock side, you've got Grota de Cerrillo in Brazil. It's an operating spodumene mine that's in a massive phase 2 expansion to nearly double its production.
And its mine life.
25 plus years. It's a true foundation asset.
What about on the brine side?
There you look at Tres Cabratas in Argentina. Phase 1 is already commissioning, and they're planning a phase 2 expansion to triple capacity. The mine life on that one, 50 plus years.
50 years, that's incredible longevity.
It really is.
And you have to mention the North American assets like Adina in Quebec.
Yes, Adina is a very large resource, and the royalty interest is strong.
Let's clarify what that means for the listener. A GOR and an NSR.
Right, so a GOR is a gross overriding royalty. That's paid right off the top line revenue. The NSR, or net smelter return, is based on the final sales price.
Yeah.
In both cases, the royalty company gets paid before the miner even covers their own operating costs.
It's high margin, non-dilutive revenue, the holy grail for these companies.
Exactly. And Adina is crucial because it's backed by Agnico Eagle's critical mineral subsidiary. It's plugged right into that North American battery supply chain everyone's trying to build.
So what does this all mean for Altius as a company? How does it change them?
It fundamentally transforms them. We track their consensus net asset value, or NAV.
Okay.
Pre-transaction, their base and battery metals component was only 19% of that NAV. Post-acquisition, pro forma, that component jumps to 42%.
From 19 to 42%.
Overnight, it instantly turns Altius into a major battery metals player while still, maintaining its diversification.
That jump to 42% is key. I mean, couldn't that change their eligibility for specialized ETFs and indices?
It absolutely could. It could attract an entirely new class of institutional investors who are focused solely on the electrification thing. It opens doors to capital that wasn't interested before.
And they get the expertise, too.
They do. LRC's CEO, Ernie Ortiz, is joining Altius's corporate development team. That ensures continuity and leverages his network for future deals.
Okay. Now for our segment. This is not financial advice. We're going to dive into an outrageous but plausible trade idea based on everything we've just walked through.
Right. So we established that Altius is making a leverage bet on a price reversal. That $40 to $60 million revenue forecast is just the baseline.
It's the floor. The real value is the embedded optionality if prices rebound.
Precisely.
So the trade idea here is to buy deep out-of-the-money long-term call options on Altius Minerals.
With an expiration date way out, late 2028, maybe 2029.
And the rationale?
The rationale is simple.
Yeah.
Leverage. If lithium prices stay flat, okay, these options likely expire worthless. It's a high-risk play. But this acquisition has bundled 37 royalties that are just sitting there waiting for the cycle to turn. If prices just go back to, say, $30,000 LCE, that $40-60 million revenue forecast gets blown out of the water.
And if that 2026 supply deficit is deeper and longer than consensus thinks, and prices spike back toward those old $80,000 highs,
then the revenue generated from this newly expanded royalty portfolio would create exponential massive upside for the stock. It's a bet that Altius absolutely nailed the timing and that the coming lithium shortage will be severe.
A bet on the demand curve winning against the sluggishness of supply.
You got it.
That wraps up our deep dive into Altius Minerals' $520 million move on Lithium Royalty Corp., a huge bet on the inevitable lithium deficit.
So as you look ahead, consider this. Global lithium demand projections are hitting 4.5 million tons by 2035. That's a huge supply gap to fill.
A massive gap.
So the question for you to mull over is, how much higher does that incentive price have to go before miners break ground on new projects? And what kind of, well, eye-watering leverage will the royalty holders capture when that price pressure finally arrives?
We encourage you to keep exploring the macro trends driving this consolidation. We'll catch you next time for the next deep dive.